If you are wondering how to analyse return on equity, this video will look at the efficiency accounting drivers of return on equity. Two other videos look at the leverage and profitability accounting drivers. As we have seen, abnormal earnings equals return on equity minus ROE minus 1, all times book value of equity. Another way of saying this is that abnormal earnings is driven by three things: return on equity, cost of equity capital, and the book value of equity. One of the accounting drivers of abnormal earnings is return on equity. In turn, there are three parts to a firm's return on equity: leverage, profitability, and efficiency. In this video, we will focus on efficiency. Efficiency is how well net operating assets in a business are being used to generate sales or turnover. Turnover is another word for sales. It is measured as the relationship between assets and turnover, called unimaginatively asset turnover. We define asset turnover as sales divided by net operating assets. Asset turnover is the amount of sales generated by each dollar of net operating assets in the business. It is the ability of net operating assets in the business to generate sales. Alternatively, asset turnover can be looked at as its inverse. 1 over asset turnover equals net operating assets divided by sales. The inverse of asset turnover, that is 1 over ATO, is the amount of net operating assets needed to be put in place in the business to generate each dollar of sales. An average asset turnover in the US is about 2 times, but it can vary widely between firms, with most firms having an asset turnover between about 1 and 3 times. A firm with an asset turnover of 2 times can generate $2 of sales each year for each dollar of net operating assets put in place in the business. Or alternatively, 50 cents of net operating assets are used by the firm to generate each dollar of annual sales. It is easy in business to overlook the importance of a firm's asset turnover. Return on net operating assets is driven by the interaction between profit margins and asset turnovers. This is the DuPont analysis of operating profitability. Usually there is a trade-off between profit margin and asset turnover. The higher the profit margin, the lower the asset turnover, and vice versa. For example, supermarkets typically make low profit margins on their sales, say about 3%, but generate a lot of sales from their operating assets. Asset turnovers of 3 times are not uncommon. In contrast, luxury car dealerships typically have much more substantial profit margins, say about 10 to 15%, but generate much less sales from their operating assets. Asset turnovers of 1 times or less are not uncommon. In most businesses, there is a trade-off between profit margin and asset turnover. As a firm increases its profit margin, its asset turnover tends to decline. And as a firm increases its asset turnover, its profit margin tends to decline. For further information on analysing return on equity efficiency, go back to Chapter 4, Section 4.4 in the study guide and review the Understanding the Past questions. Also, answer, write and rate questions in Peerwise.